So today we're going to be working on kefir 2. So in the kefir 1, you were doing feasibility and you were doing a comparison in the mix of production between the kefir beverage and kefir cheese. And you recommended introducing some cheese, at least some percent, minor percent, in order to improve profitability and replace their salaries. And they took your advice. So you can see here you've got actual results now in your kefir 2 file, and you have 6 months worth of data. So you know the cases of kefir that were produced and sold. So a little bit of difference between what was produced and sold, not a lot. Over the 6 months, they produced and sold exactly the same amount, but not in every single individual month. And then they made some of the cases in cheese. So they did follow your recommendation. So the price per case, it went up a little bit at the end for both kefir and cheese. So just something for you to notice there, that it started a little bit below budget, but then got up to budget. And then here we started a little bit below budget because we budgeted $30. And we're inching up but haven't quite got back to the $30. So just kind of paying attention, just scanning the data and just getting a look at what went on with the client. We can see how many gallons they consumed in making those cases, and you can probably quickly do the math. We were supposed to use 3 gallons per case, and you can probably figure out if they did or not. Here's what they spent on that $89,000, and you can probably do the math and figure out if that's what they should have spent. Here's how many labor hours that were consumed, how much they paid for the labor, how much they paid for supplies and other overhead and fixed overhead, what the commissions were, and then what the fixed selling administrative costs were. So I'm not sure what these computations are down here, so I guess we won't need those. That looks like something I was doing when I was creating the project and should have erased it at the end. I've already set up the grid for you here. And then over here, this is a flexible budget and a volume variance budget where you can isolate how things were different from the original standard cost and budget and talk your client through it. But I just wanted to do some of these variances with you just to kind of get you started and give you a possible way to study the data systematically. Your client may or may not need to see all of these. That is a judgment call, and you will make those judgment calls after you've done the calculations and soaked on them a little bit and see what do they mean for the client. Where should the client be thinking about their business? Where did it go well? Where did it not go well? What are the trends over time? And that sort of thing. All right, let's get started. All right, so let's see. What should they have paid? Price variance is the difference between what you should have paid and what you did pay. So what should they have paid? In January, they should have paid for each of those 89 gallons $3.50. And if we anchor the price per gallon here, we can then pull that across. And we can get a sum. We can get a 6-month total. And then what did they pay? They told you that. Cost of the milk. And then you can again just pull that across, pull that down, and you have a comparison. And then you can calculate the price variance. And so typically the price variance would be an absolute value and a favorable or unfavorable, but in Excel, we're going to use the plus and minus just because of the math. But remember that when you're interpreting this, the plus and minus is typically not used. It would be an absolute value with favorable or unfavorable. So this is just a raw scratch sheet, but if you were doing a more formal presentation, you would do the absolute value in favorable and unfavorable. All right, so what should they have paid minus what they did pay? So negative here would be overpaying, and positive would be paying less. So in every month, it looks like they paid more than $3.50, and in some months substantially more than $3.50. So there's probably something to talk about in terms of the price of milk. All right, now let's talk about usage. How many gallons should they have used? Okay, so now we have to go over here and figure out what was produced. So we have these cases plus these cases, and for each of those you should have used 3 gallons. And let's put our brackets in here so we have our order of operations correct. And then for the 3 gallons we can anchor that. All right, so we've got the production of kefir and the production of cheese, and we added those together and multiplied that times the 3. All right, and then since we anchored that, we should be able to pull that over, and then we can add that up. Now, how much did they use? All right, let's go on over here and see how much did they use. So, milk used. Okay. Let's turn that back into units here. And then that difference between the gallons they used and the gallons they should have used would be multiplied times the standard price per gallon, which is the $3.50. We will anchor that. It turned it into an absolute reference rather than a relative reference. And now we can do the calculation. So how many gallons should they have used minus what they did use times that $3.50. And we'll get the order of operations correct here. And so negative in this case is using more than what was allowed, and positive would be using less than what was allowed. So we can sort of scan here and see that there was overusage, but that overusage seems to be getting smaller and smaller over time, and that sometimes can indicate a learning curve. So just some thoughts there as we're just reflecting on that. All right, let's look at the labor. So what should they have paid for labor? All right, so let's see, how many hours did they work? And what labor rate should they have paid? Where's our labor? There we go. All right, so let's anchor our labor rate and then pull that over. And then what did they pay? And now you can do a comparison. So what they should pay minus what they did pay, and you get a variance. And we can pull that on over. So what observations can we make here? It looks like they were underpaying initially, and then they started paying more and more and more until finally they were at standard. All right, what about the efficiency variance? So how many hours should they have used? All right, let's have a look at that. So there's a different labor use for the different products. So for these 25,000 cases, we should have used 0.4 labor hours. And for these cases, we should have used 0.7. All right, let's get our brackets in here correctly so that Excel does the math correctly. All right. And then we'll need to anchor some of this so that it'll drag across for us. If you have a PC, clicking in the address here and hitting the F4 will give you your dollar signs. If you're using an Apple product, a Mac, you will have to type those in manually. I'm not sure how to do it non-manually. Okay, and then how many hours did they use? Let's go on over here. Labor hours worked, which they give you. Okay, so we'll put the standard price in here per hour. Alrighty, and now we can calculate this variance. So what should they have used minus what they did use times the rate. And we'll put our brackets around that. And then pull that over. And just inspecting that, it looks like it was unfavorable in the first month, and then it got quite favorable. So they seem to be able to put the kefir and the cheese together a little faster, actually, than what you initially thought. So a little bit of good news there. Now, what about supplies? So how many should you have used, and how much did they use? So the supplies differed based on what they were making. So for the kefir, the supplies are going to be the 210. And then if it's cheese, the supplies are going to be the 410. All right, let's get our brackets in here so that it multiplies times the right thing. Okay, I guess we better get it in the right direction. There we go. Okay, and then we will anchor the standard quantity. And what did they use, which they gave you? And so here we just have a spending variance. And so they should use this, they did use that, and we can see what's going on with supplies. Well, that's some real unfavorable variances there, so that's probably something to be studied. All right, let's try the overhead variances. So actual incurred, and then the hours used, and then there's a different rate for the hours for other overhead. Let's anchor that down. Now, how much should we have used would be the hours times that rate. So now we're comparing the 27 to the 19.5. So we should have spent this, and we did spend that. All right, so I think I anchored everything I was supposed to anchor. Let's find out. Okay, there we go. So we've got 2 months of really serious unfavorable variances, and the other months seem to be okay. So there's probably a story behind that. It's one you could ask your client about. You don't have to speculate, by the way. These variances tell you the questions to ask. They don't tell you the answers to the questions. They help you to direct your client's attention towards what needs investigation. So that was the spending variance portion of the variable overhead. Now we're going to do the efficiency portion of the variable overhead. In other words, when you use too many labor hours, you're also incurring overhead related to that excessive hours. So this vacation pay, the overtime, the use of the factory if you're there longer, that sort of thing. All right, so hours they should use, we already know that. Hours they did use, we know that. And then the standard price per hour is the 150. All right, and then the efficiency variance will be the hours we should use minus the hours we did use times that rate. And let's get the brackets in there so the math will be done in the order of operations that we desire. And then let's get the 6-month summary. So let's look at the spending side of the fixed overhead budget. So they tell you what they spent. And we can sum that up. And then the budget was just a fixed amount. And then what you should have spent, which was the budget, compared to what you did spend. And so not, okay, so that's a very minor area, so it doesn't look like the fixed overhead. And then you can get your overall cost variances if you like, just to get a feel for how big the whole world is in terms of the variances, not that that would necessarily be revealing. We tend to study variances individually because as a whole they offset each other and prevent us from finding out what's going well, what's not going well. So, but 113,000 in variances is a pretty eye-catching number, and that's net. So if you just took the unfavorable ones and added them all up, it looks like you'd be looking at even more. And that's the client advice digestion portion of the project, is for you to now study. We've calculated them. You have them in front of you. You know your math is okay. So now it's a matter of you trying to understand them. Now these are only the production variances. Over here, you may have you may or may not have variances in the selling area, so that you have the data and you could figure those out. So you can figure out now the budgeted income statement, you can figure out the flexible income statement, you can figure out the actual combined for all of these and get the variances. Good luck. I look forward to seeing your work.